Welcome, traders. Not everyone who engages in the financial markets has come from a financial background. In fact, the financial markets are accessible and an opportunity for any person who's interested in learning how to benefit from them. I would encourage as many people as possible to find out more about them and get educated. One topic that non-financial folks tend to not appreciate enough, which is normal, is the idea of risk management. It's a funny thing, but humans are actually terribly bad at identifying risks generally. We usually only see something as a risk when we can see how it directly and immediately impacts us. If it doesn't immediately and directly impact us, we often ignore the dangers that it represents. Climate change is a good example of that. One area where we are starting to get it right for the average person would be insurance policies. These are policies that will cover us in case our car is in an accident or something of ours is stolen, or heaven forbid, our house catches on fire. And what we need to learn to do is to apply this approach to either our investing or our trading activities. What we're really looking to do is to create a parachute, or as I like to refer to it, a bulletproof vest that will protect our capital when we are looking to build it. Not every risk we take is that dangerous, and not every risk that we take is going to succeed. As traders, we want to make sure that the risks we take, first of all, are not too dangerous, and if they do fail, that the price we pay is as little as possible. There are two things for certain in trading. Risks are unavoidable and losses are unavoidable. I could give you a long history lesson about how risk management is an art form and an industry in its own right in every single form of business around the world, but instead I want to focus on the concept and why it's so important, not just to our survival as a species, but to our account survival when we start to speculate on the market's movements. Allow me to oversimplify what we do as traders. At its core, we look to identify patterns, visual patterns that occur in the markets, on the charts on a frequent basis. These patterns have a tendency, not a guarantee, but a tendency to unfold one way more than another. Some patterns have as high as an 80 or more % chance of unfolding a particular way, but it isn't guaranteed. So we need to balance the probability of success against the cost of failure. The way in which we do this is with our own custom-tailored personal risk management plan for trading. I should also add that confidence allows us to trust our own decision-making processes and to believe that we can succeed in a situation which is fraught with emotional, financial, and psychological dangers. Our confidence and our belief in our own abilities comes from practicing and seeing our own improvements over time. We also need to trust our strategy, which happens when we have taken enough trades that the results speak for themselves. When we create a risk management plan, we are not only creating a plan to protect our capital while we take these risks, but we are also creating a plan that is intended to protect our self-confidence as well. We cannot avoid losing trades because sometimes the market will behave unexpectedly and sometimes we'll read the markets incorrectly. As we become better traders and as we become more experienced, reading the market incorrectly will happen less and less. But the markets behaving erratically is still a normal natural condition, just like how the weather can change without warning. By keeping our risks small on every single trade we take, we can ensure that unexpected losses are small and also that our confidence is kept intact, because psychologically it feels easier for us to recover from a small bruise than from a deep cut. The two greatest dangers to our own capital is unforeseen market events and ourselves. So we use stop losses to keep our losses fixed, and we use a risk management plan to keep our behavior in line and to make sure that we don't go crazy or harm our account if we become too emotional. Two surefire ways to make sure that we become emotional is to risk too much per position and to experience too many losses in a row. Even the best traders will become emotional when this happens. Risk management is really a way to make sure that we can recover quickly from unavoidable losses. Remember, you can jump out of a plane without a parachute. It is possible, but only once. If you're serious about trading and you want to learn more, then get in touch with me on my Ambassador's homepage at FXGlobe.